Stocks are looking to bounce back from a rough prior week. Joining me now is Freedman. He is the head of cross-asset strategy at UBS Wealth Management Research. Hi, Stephen.
Hello, how are you?
Great, thanks so much for joining me today. So stocks have been down for 3 straight weeks. How long do you think the volatility will continue, or do you think we're not going to be able to just go straight up?
Well, I think you're seeing some volatility, and a lot of this is in relation to uncertainties around the Fed. We'll know more later this week. But I think generally speaking, we still believe the trend is up because ultimately what drives stocks is earnings growth. And we think that apart from the energy sector, you still have pretty solid earnings fundamentals, and that should be helping the market to edge higher.
And the bull market just celebrated its 6-year anniversary last week. You don't think bulls die of an old age. So then what do bulls die of?
Well, typically what happens is you either have valuations being excessively expensive, that would be the example of the tech bubble, or you have a recession hitting. And right now, because this cycle has been so slow and so sluggish, we really haven't had time to see excesses build that typically lead to a recession. For example, we haven't seen overspending by companies, and we also haven't seen excessive credit growth. So at this point, we think it's still we're still in the mid-cycle, and as a result, we're not concerned a recession could be derailing the market.
And those excesses that you see at bull market peaks have not come through, as you just mentioned, and call for a recession would also be quite excessive. But stocks have gotten expensive, so when should investors start thinking that valuations might be a little too high?
Well, right now we think valuations are moderately above their long-term averages if you look at things such as price-earnings ratios. But as long as you see earnings growth continuing to be well sustained, we think that doesn't really matter. It's when you start seeing the economy roll over in combination with valuations being expensive, which again, they're not excessive right now, that's when you have to start worrying about the stock market.
And when it comes to the market, do you think that investors can just take a bite out of the S&P 500 and ride that along like they have been? Or should they be looking for more selective opportunities? And where do you see those opportunities?
I think investing broadly in the market is fine, but we do think that you have some additional potential for returns if you focus on specific sectors. The one we like right now are industrials, technology, and consumer discretionary. We like technology and industrials because these are sectors that will benefit from a pickup in capital expenditure by companies. And we like consumer discretionary because we're seeing a strong labor market, which would help the consumer, and also low energy prices help as well as an additional boost.
And some sectors you dislike or that you're underweight include utilities and such. How much does the dollar play into your assessment with the underweights?
Well, the underweights we currently have are utilities, telecom, which are very interest rate sensitive sectors and which will be under pressure as bond yields rise, which we expect. And we're also cautious on materials. I wouldn't say that the dollar plays a big role in terms of the sector composition. Where the dollar does play a role is we have a preference for small and mid caps over large caps. And here we think that the small and mid companies, which tend to be a bit more focused on the US and have less other earnings coming from abroad, they will be more insulated from the dollar strength than the large cap space.
Thanks so much, Stephen. Stephen Freedman is the head of cross-asset strategy at UBS Wealth Management. And for The Street, I'm Susanna Lee in New York.